Hey, good morning, everyone. Marty Mazzora here. It's Friday, May 5th, 2023, with your end-of-week stock market snapshot. Before we get into the technicals, into the charts, I want to talk just a minute or two about this morning's action, what I think's going on, where I think it's coming from. Pretty massive rally, or let's say strong rally for sure. As I talk at you this morning, the S&P is up 1.4%. NASDAQ 100 is up 1.42%. Just about everything in our core portfolio is up with the exceptions of silver and gold and long-term treasury bonds. Gold being a not small position, as you all know, for us. It's down 2%. Intermediate term treasuries, AT&T is flat, down 0.04%. And then local currency emerging market bonds are down 0.04%. So we actually have 37 positions, some larger, some smaller, of course. So just a handful of them are down on the morning so far. Albemarle, the U.S. lithium miner, is up 5%. Oil services stocks are up 3.5%. MP Materials is up 3%. Energy stocks, XLE, the broad large cap energy companies, are up 2.8. Dutch Bros is up 2.8. Uranium miners are up, and financials are up a bunch for a change. They're up 2.1%. So the next bull market stocks that we own, the more materials, commodity-oriented stocks, are the ones that are really taking off. Today, our base case remains that that's premature, and we don't want to get out over our skis there just yet, because if we do have a recession, there's going to be better buying opportunities there. But it's nice to see. No ifs, ands, or buts about it. Certainly not complaining about an up morning. You'll never catch me do that, because we're always going to have some exposure to the upside, even when we're generally bearish as we are right now. So this morning we got a jobs number that beat expectations, and you're hearing all about that. So I'm just going to touch base briefly on the jobs number, because, of course, we're going to get into that in more detail on the weekend economic update. But this morning, I think the general belief is that this is a big reaction to today's jobs number. And it's a reaction because the jobs number was strong, and therefore the economy was strong. I think you can push back on that a little bit. Well, we had, I think it was 280-some thousand jobs created. And again, we'll get into the minutia in the next video. But we did see 143,000 revised lower than the previous 2 months. Unemployment did tick down to 3.4%. Hourly wages ticked up a little bit. And so you would think, though, with the exception of the revisions, which would be bearish for the economy, you would say, wow, that's, an inflationary report, or maybe that's certainly not the kind of jobs report that would inspire the Fed to back off of its efforts to slow inflation, and that's been problematic for the market for sure. So if that's the case, then why is it rallying? Because, the market's been trading down on good, positive news. I think I said in the last video that if we have a good, strong number, the market's going to sell off. If we have a relatively weak number, the market's going to rally. We kind of had neither. Maybe even from terms of numbers, I would say, it leans toward the weak side because of these revisions. But when you look at hourly wages and so forth, that would lean towards the strong side, which would be problematic potentially from an inflation standpoint. So what's the market really all giddy about this morning? Well, it's Apple yesterday announced better than expected earnings. Of course, the earnings bar had been ratcheted lower. Nick and I look at Apple a lot. We were talking about it yesterday. I said, Tim Cook is quite the shepherd of Apple's stock price. So I said, wouldn't surprise me in the least to see him announce an addition to their stock buyback program, just to boost the stock. That's why he would do that. And that's exactly what he did. $90 billion additional stock buyback. He even raised the dividend. And he was able to pivot from the negative news in China to the positive investments that they're making in India. And I think that's really smart. So you got to hand it to him and to Apple to be able to be on their toes, pivot in terms of where they make their stuff, where they sell their stuff, and so forth. And you got to hand it to Tim Cook because he is really adept at pumping the stock price. And I'm not saying that's bad. As shareholders would absolutely love that. It is the largest company in the world, largest in, of course, the indexes that we tend to track here on the videos. And so that's not small in terms of the impact today. Whether or not it's lasting, whether or not this is a durable move, I think remains to be seen. This is looking very much like last week, only it's pushed back further to today, at least so far. That's if this rally holds today. Meaning you start the week off weak, and then you end the week strong because something comes in and saves the day at a minimum from a narrative perspective. Other things that we'll talk about in that jobs report is temporary hirings have been diminished, and that's generally a leading indicator, whereas jobs and unemployment rate are actually lagging indicators. It tells you what happened yesterday. Just one more factoid, because as I said, I don't want to get too deep in the weeds, but our research partner Numera sent out a note this morning, and they talk about the fact that actually it was 253 was the jobs move in April, reading their brief narrative with the pace of job creation slowing only marginally over the past few quarters. The unemployment rate remains at cyclically low levels. In a context of weak confidence and high interest rates, plentiful job opportunities have helped fuel consumer spending. We've talked a lot about that. Looking ahead, however, leading indicators, and this is what we've been pounding on here, warn of a significant slowdown in consumption. Hiring intentions by small and medium-sized enterprises are starting to weaken, pointing to rising joblessness in H2, second half 2023. In addition, lending surveys suggest banks are tightening lending standards, which we expect will further weigh on both spending and hiring moving forward. I'm just thinking out loud, is this market really responding to good jobs data? Or did they get confirmation today, frankly, that the employment picture is weakening? And from what Chairman Powell said yesterday, when we get the senior loan officer survey next week, it's probably going to tell us that banks are significantly tightening their lending standards. And that's bearish economic news. And so there's enough, even in these jobs numbers and in other related data, that actually kind of supports the notion that the Fed doesn't need to be as tight or could be loosening monetary policy. Maybe the rally is more about that. Now, that's not reflected in bonds and gold today. They're moving as if the Fed's going to continue to tighten. I'm just talking about equities right here. So if the bond market and the gold market is correct, well, then this rally is not going to be durable by any stretch of the imagination. If the stock market is reflecting the potential for a softening Fed, it will be more durable, meaning these levels will hold up longer, only to give up these levels and some if indeed the Fed is cutting interest rates in the back half of the year, because that's going to be a recession, and that's going to weigh enormously on corporate profits and stock prices that just don't reflect that reality just yet. So the stock market may be living in a little bit of la-la-land, meaning, oh, great, this is weak enough that the Fed's going to slow down and ease off. Maybe they're thinking soft landing. That's a tough one. But if they're hoping and praying that the Fed's going to be easing off, they got to be careful what they hope and pray for, because the Fed will not ease off in this inflation environment unless things are looking really, really bad economically. And I mean ease off by pivot and start cutting interest rates. So kind of all over the place in that narrative, I know, but lots to think about. Reality is not necessarily being reflected in what we're seeing in the headlines today and what we're experiencing in the markets. So with regard to technicals now, in front of you is that daily, 1 year daily S&P 500 chart. Each candle is a day. Again, we had a bull flag pattern that wasn't my base case that failed. My base case was this rising wedge pattern, which is a bearish pattern. We kind of saved it here. I didn't quite bounce against the 50-day moving average, but you can see that can be some pretty strong support. And right now, the S&P is trying to get back above that 20-day moving average, which has been problematic. So as I've pointed out many times here during this bear market, that 20-day moving average has been a good near-term indicator. When you break below it, it tends to be something significant to the downside after a test or two, right? So here we broke below it. Here we ramped back up. Looks like a failed test. Now we're testing that again. If we come into next week and we break that down, this could be something worse to the downside. With regard to the momentum, again, while this is a very impressive rally, and I'll show you how impressive this is with the last two slides, but technically speaking, nothing really, absolutely nothing has changed. You have, you have this consolidation range in here, and you have massive bearish divergences on the momentum indicators. So, as I keep saying, lots of technical damage to be repaired before this, at least the daily chart, looks anything bullish by the way we look at it, other than bouncing off of and being above the moving averages. Looking at the 60-minute chart real quickly, so this is a 60-day, 60-minute chart. Each candle being 1 hour. So earlier this morning I drew this long consolidation phase. This takes us back to the end of March, and so we've kind of established this range, right? Came up, tested it right here, about 41.60, let's say, broke above it, lost it right in here. Remember here, this by the way, I'm not going to claim that that's a bear flag pattern. Actually, it was looking like it right here, right? And then that flag pull would have taken us down closer to 4,000. We're just kind of consolidating with an upward slope, but I added that flag pull to it, just playing around with the technicals here. It took us right to where the market bottomed this morning. Big gap up, as you know, this morning. And again, I think that's as much about Apple's earnings as it is about the jobs number. And so, that creates a bit of a gap here to fill, and our base case is that we will. And some. So right now, I would look at resistance right in here around that 41.60 and continued support here right at about 40.50 on the S&P 500. Looking once again at the NASDAQ 100 index, here we go. We're just right back, testing that top end of that consolidation range once again. And, we did break out of this rising wedge pattern, but not to really any great degree. And stubbornly, the NASDAQ 100, which Apple is massive in, of course, wants to keep coming back. Again, though, folks, just not a good look right here. These would be shorting opportunities for short-term traders if they generally have a bearish thesis. So we'll see. Could we break above that and repair all this damage? Absolutely, we could. The next level would be 333 on QQQ. By the way, I said NASDAQ 100. This is the ETF that tracks the NASDAQ 100. Speaking of Apple, I thought we'd just go ahead and take a look at that chart as we have been of late. You can see with yesterday's earnings, we're breaking above the rising wedge pattern, so an upside breakout, very bullish. Nascent buy signal right here where the white line is peeking up above the red. However, the slope still is very bearish on the RSI. About to get to overbought territory, and obviously what you have here is just nothing but an extension, of the rising wedge pattern. Might look for a 180. I listened to Dan Ives. He's a tech analyst this morning. He sees it 200 and above. Cannot agree with him when I look at the technicals. That would sure be nice. I would not complain. It certainly wouldn't hurt us in terms of our portfolio. Just not what we expect when we look at the big, broader general conditions picture, if you will. Just because we've been talking about the VIX a lot lately, here we took a stab above 20 yesterday, just massive move. Here we are coming down back off of that. Again, that's once we get below that 20, we can get some choppiness for a while. For a while there, though, once we hit it or once we pierced it, that was the top, right? So the VIX goes up. It measures implied volatility on S&P 500 options, and so typically, not always, but typically there's a negative correlation there, and I would expect that to play out here. So we're in this range that's been a very dangerous range on the low side, somewhat complacent maybe. From a technical perspective on the VIX, again, still a bullish-looking chart. We have this lower low there against higher low on our momentum indicators, and of course we're coming back off of this resistance like I just showed you at 20, but nothing yet that looks bearish, meaning down VIX, up stocks so far, at least when we look at the daily chart. So I wanted to look at volume, right? I've been sharing with you the on-balance volume chart on the S&P, and then I did the other day on the NASDAQ as well. I've been showing you that it looks like the market's been getting distributed, meaning that people have been selling the rips as opposed to buying the dips. But today, although it's waning a bit, we do have notably above average volume at 16% or so. Let me get rid of those lines. It's 16% or so above 20-day average volume right here, and here I'm featuring 5, 10, and 20. So good volume to this point. So this just shows you if it continues at this pace, this is where we are right now. You break it down by sectors. Looks like industrials are seeing less than average volume, as is it's consumer discretionary down here as well. Healthcare too. Otherwise, above average volume on the major sectors. In terms of breadth, the breadth has been terrible of late. Today, the breadth is really good. So we have 446 up versus 57, 58 down on the S&P 500. However, I showed you that we're above the 50-day moving average. We're way above the 200-day moving average in the index itself. However, only 50% of the stocks are above the 50-day moving average, and less than 50% are above the 200-day moving average so far, and that's not good breadth. You want to see all boats, or at least most boats, rise with the tide. Right now, quite a bit less than that. And as I've illustrated for you lately, so far, you take out 5 or 6 stocks of the S&P, and it's just barely up on the year. So a market that's got such poor breadth is not considered a healthy market, obviously. And then lastly, just to look at the short interest, this will get updated for us this afternoon. This is the kind of net short interest among non-commercial speculators in S&P 500 futures contracts that we saw back during the European debt crisis, and before that we saw back in 2007. So this denotes either huge bearishness or huge hedging of long positions, or combination of the two, I suspect, but a lot of concern about the future of the market. Now, a short, once again, is a sold security, a sold futures contract, a sold share of stock, a sold options contract, right? But it was borrowed and sold and needs to be paid back. So somebody who shorts thinks they're going to borrow something, sell it at a given price, buy it back at a much lower price, give that something back to the lender, and pocket the difference. So obviously there is unlimited downside risk, because if you borrow something, you short it at a given price, you have to give that something back. So if the stock goes up, you have to pay more, maybe substantially more than what you sold it for, and that's money out of your pocket, and that can be devastating. So what we look for when we have high short interest is a situation where something happens, the market that they're shorting goes against them, and they rush to cover those shorts, and that's buying pressure on top of whatever pressure's coming from the good news. So you can get these massive short covering rallies. So that's what I said the other day. I said, back in 2007, these folks were correct, and the market went down another 50% from levels this short, right? But along the way, you get a little good news, and they're going to get it handed to them on these short covering rallies. So I think there's little doubt, certainly little doubt in my mind, that the 1.5% amazing that the S&P is up this morning is impacted in a not small way by short covering. And then in closing, just to put where we are today in perspective, this was Monday up here. So despite today's big rally, it looks like the S&P is going to be down a bit on the week. But what a valiant effort to regain some ground here. It'll be very interesting to see how all this news gets digested over the weekend and how the market comes into next week. Again, our base case remains that recession's probably coming. I'll say it one more time. Valuations and earnings aren't reflecting that, and that we see something below the previous bear market low of 3,500 before it's all said and done. Doesn't have to happen that way. That's just what the overall general conditions fundamentally and quite frankly technically tell us as well. But I don't think it happens tomorrow. I don't think it happens next week. I think it could happen in the second quarter. More likely it's a latter half of the year affair that coincides with the reality that the economy is probably in worse shape than people may think it is right here at the moment. Folks, I will leave it there. Thank you as always for watching and listening. Next up will be our economic update, which will come to you sometime over the weekend. Take care. Have a great day. Bye-bye.